In today's video, I want to share with you how you can apply two of my most popular and favorite supercharged Roth IRA conversion tools to reduce the tax liability on million-dollar Roth IRA conversions. Not only can you use these tools to reduce ordinary income that's generated from a Roth IRA conversion, but you can also use some of these tools to reduce your ordinary income from W-2 income and from other forms of business income that you may have. If you're doing a lump sum million-dollar Roth IRA conversion, you'll pay close to $400,000 in taxes. However, by implementing these tools, you can take that tax liability down to zero. You heard me correctly. By implementing the supercharged Roth IRA conversion tools correctly, you can take a million-dollar Roth conversion and pay zero taxes. If you've got $1 million of W-2 income, you can take that tax liability down to zero. I'll show you how you can do it legally, how you can do it ethically, and you will not be hounded by the IRS because you've integrated some harebrained tax IRA tax planning scheme. Let's get into it. I'm going to share my screen and you can see exactly how this works. Okay, so first off, here is our happy couple, right? They're smiling because they've learned how they can reduce their tax liability and save hundreds of thousands of dollars in taxes. This is their snapshot. For the folks that give us a call, we give them access to our Roth conversion planning software where you can kind of see these before and after scenarios of what the bottom line impact and the real world impact is of applying these supercharged Roth conversion techniques. But here's our situation. Let's see if it applies to some of you on the call on the video. They've got $500,000 in cash. They've got $2 million of invested monies. $1 million is in a non-qualified brokerage account, and $1 million is in the IRA account. They're both age 65. They've got a pension, and they've also got Social Security benefits that pay for their expenses. They are in the unique situation where they do not need the income from their tax-deferred accounts. So we're going to illustrate the problems that creates for them if they don't do Roth conversions. First off, let's look at their net worth. So this blue line on the bottom, it shows how their net worth grows. Again, they've got a $2.5 million net worth now. Their assets are increasing in value. Their allocation is split up pretty conservatively between 60% of large cap growth stocks and 40% corporate bonds. They keep that allocation throughout. And at age 100, they have an ending net worth of $41 million. So they've got 100% chance of having a successful retirement. The issue comes in of how can they be more efficient? And that's why they contacted us. They wanted to be more efficient with their tax plan. They recognize that they're on a tax time bomb. So this chart shows the impact of taxes throughout their retirement life. Notice that between the ages of 65 and 72, 73, it's pretty small, about $20,000 a year. But once they hit age 70, when is that? Age 70, 73, boom. Their tax liability increases from $26,000 a year up to $49,000 a year. Again, this is not doing any Roth conversion. This is following the status quo of just keeping your money in your IRA and 401k accounts, your tax-deferred IRA accounts, and paying those required minimum distributions when they're due. You don't need to spend the money. You deposit the required minimum distributions into your brokerage account, and that generates more taxes for you. Although that is one way to go about doing it, we think there's a more efficient way. Let's illustrate what happens if they do a lump sum conversion. So we're going to do a $1.1 million lump sum Roth IRA conversion. Their tax liability is immediate, right? They're paying $416,000 in taxes lump sum. But look what happens over their retirement life. They're saving $3.7 million in taxes because they bit the tax bullet all at once. And I know some of you who are watching this video are thinking about doing exactly that. Or you've already done a Roth conversion in 2024, and you know you've got this big looming tax bill, and you're wondering if there's anything you can do of what's left in 2024 to reduce that tax liability. The answer is yes. Okay. But let's look at the impact on the net worth. Obviously, if they don't have those required minimum distributions throughout their working life or throughout their retirement life, and they're saving $3.7 million in taxes, that can be increase their net worth by an additional $3 million. Okay. Now let's go on to tool number one. Tool number one is IRS publication 590. This is a tax hack that we can teach you how you can implement in this calendar year. And you can use it next year as well in 2025 until Congress takes it away. Almost every year there's proposals put in to take this tax hack away from savvy retirees. And every year there's lobbyists that go in and pull some purse strings and make it so it's still available. But the impact is obvious. Instead of paying $400,000 in taxes, they're paying $234,000 in taxes. Obviously, that tax liability is increase. They save a significant amount of money with their net worth. Instead of having now their net worth increases by $5 million. Remember before, if they did just the regular lump sum conversion, they had a $3 million increase. Here they've got a $5 million increase just by using tool number one. Now, tool number one is only available if you've got over $1 million of monies in tax-deferred IRA accounts. Tool number two is Section 179. This is Section 179 from the tax code that talks about depreciation. Specifically, the strategy here is we're going to show you how you can go out and purchase certain types of qualified assets with non-qualified monies. And this purchase is going to give you a $375,000 deduction against not only your W-2 income and other forms of ordinary income, but also your Roth conversion income. So this is what these folks have done. They've combined tool number one, the publication 590 hack, with tool number two, the Section 179 qualified business property expense deduction to save how much? Right? They're saving in taxes. Again, $3 million in taxes is what they're saving. But the biggest difference is the initial year one. Instead of paying $400,000 in taxes, they're paying zero in taxes. All that can accumulate for them and grow for them to accumulate a higher net worth. So in this case, it's a $7 million differential by applying tool number one and tool number two. All right. So just for kicks and giggles, let's look what happens if they put their monies into 100%. Well, let's piece into this. Let's go 100% large cap stocks, right? Again, these are retirees that their basic needs have already been taken care of because they have a good pension and they have good Social Security monies. By not taking their required minimum distributions or not being forced to take their required minimum distributions, they're getting more of their Social Security benefits income tax-free. So all these funds get to grow and accumulate for them inside of the Roth IRA and compound over time. So if you have an income floor and that income floor is secure and it's paying for your baseline expenses, why would you have monies in lower performing assets? So for this illustration, they put them all in 100% large cap growth stocks, and it increases their net worth by an additional $38 million. If they went crazy and said, we're going to roll the dice, not roll the dice, we're going to put it in small cap company stocks, right? One of the most aggressive asset classes that there is, but mathematically, this asset class has performed beautifully over 20 and 25 year periods. It's the highest performing asset class according to Standard & Poor's. Look at that, a differential of $42 million. So if you remember from the first slide, their ending net worth on not doing a Roth conversion was $41 million at the end of their retirement life at age 100. They would have paid a little over their lifetime taxes was $5.8 million if they didn't do a Roth conversion. By implementing these two tools in tax year 2024, instead of paying $400,000 in their lump sum conversion, they're taking that tax liability down to zero. All of those tax savings going to grow and accumulate for them over time. It increases their net worth by a staggering $42 million. Ending net worth, $83 million. Now, if you think this is pie in the sky, and these are crazy numbers, and these things aren't valid, run the numbers yourself, right? Go to the IRS tax estimate calculator, throw in what the projected value of your IRA is going to be when your required minimum distributions kick in, and look at how that changes the tax liability from year one to year two. I'm saying there's a more efficient way, there's a more effective way to do that. And that's what we can share with you on how we've been doing that with our clients. For those of you, again, that don't have tax deferred IRA accounts, these strategies work if you have high W-2 income. I ran a scenario for a couple just yesterday. They're out of Washington. They had $1.2 million of income. We showed them how they could use that tool number 2, the Section 179 business expense deduction, to take that tax liability down to the 10% bracket. So if you'd like to get more information, click on the link below, get on my calendar for a 15-minute consult, and I'll run through more details. I'll give you access to this tax planning software. You can run some of these numbers for yourself. Be smart about this. Be efficient about this. Remember, there's two types. There's two types of people that are affiliated with the tax code, right? The two types are those who know the tax rules, and then the rest. We've been doing this for several years. We've helped educate thousands of clients on how they can apply these tax planning techniques. I know that they'll work for you in 2024, and I know that they'll work for you in 2025 and beyond. Give us a call, get on the calendar. We'd love to help out. Thanks.